How's it going, guys? As you all know, my name is Nick, and today I have one simple question for you. Are you ready to begin investing to start making thousands, if not millions, over the course of your lifetime through the stock market? Yep, that's exactly what I thought. But what I've learned through my investing journey is that there are several things that you absolutely need to know before you start investing, and this can be very beneficial in the long run. Because if you lack any of this information or you don't plan it out in advance, then it can definitely harm your returns and definitely cost you a lot more money than it needs to. And I can tell you for sure, this has definitely negatively impacted my portfolio because I didn't have a mentor to tell me many of these tips that I'm about to tell you. As a new investor, it's very difficult to know if you're actually making the right decisions or doing enough planning in advance. So that's why I want to help you today with a lot of these tips. So you'll definitely want to stick around until the end of the video just to gather as much value as possible. So without further ado, let's jump into the 5 things that you need to know before you start investing. Alright guys, the absolute first thing that you're going to need to know is something I like to call your investing style. And for new timers, it can be very intimidating because there are so many different types of investing styles that you hear about. And so I want to clarify this and only give you 2 of the main ones that you should consider. So the 2 main types that you should be aware of are long-term investing and short-term investing. So short-term investing is also known as day trading, and it's basically when you're holding an equity or a stock, ETF, or bond for a very short period of time. This can be minutes or even seconds, and then you sell that to try and gain a profit based on the smaller fluctuations in the market. Whereas long-term investing is when you plan on holding a stock for months or even years at a time, and you end up trying to capitalize on the larger market fluctuations that are more noticeable. Personally, I am a long-term investor, and this is because you can't really tell what's going to happen in the short term in the market. Anything can cause ups and downs, but in the long term, you know that corporate America is always going to do well. And this is exactly what Warren Buffett, also known as the greatest investor of all time, tries to teach us, and the style that he implements into his investing. Now, once you've determined whether you want to be a long-term investor or a short-term investor, it's very important to know if you actually want to take an interest in developing your portfolio. So if you do enjoy investing and you want to start building your own portfolio and spending a little bit more time researching companies, this would be considered taking a more active approach to investing. On the other hand, if you'd rather spend your time doing other things in life, this is also okay, and this would be considered more of a passive approach to investing. So I just want to say both are equally valid approaches, but you definitely want to figure this out whether you're going to be a passive or active investor in the future. Just so that you can develop your portfolio accordingly. And just a quick reminder here, if you do enjoy this video or gather any value, just smash that like button down below. That would be much appreciated. So with that said, we're moving on to the second and one of the most important things that you need to realize before you start investing, and that is your risk tolerance. So many investors get started right away without even considering which level of risk they're actually comfortable with. But this can be a problem because when their investments actually fall down 20 or 30%, they can't handle the fear, and so they actually sell out right away and realize crazy losses. And this is actually one of the worst things that you can do when your investments just go down with the general market, is to sell at the bottom. So one of the best ways that you can help determine your risk tolerance is actually through something called paper trading. And what paper trading allows you to do is actually build an actual portfolio of stocks, bonds, or ETFs, whatever you want, and it trades like it's a real stock, but it's actually with fake money. So you don't put anything down and there's no risk at all. The thing I like about this is that you can actually play it as if it's real. And what you should do is take some risks and see how the volatility in your portfolio actually affects you personally. And this will help you develop your risk tolerance. But at the end of the day, it really won't cost you anything for doing this, even if you make a crazy bad mistake. Another way that you can assess your risk tolerance is actually through an investor profile questionnaire, which you can find through your own bank online. Before I started investing, this was actually recommended to me by my friend, and I actually did fill one of these out, and it gave me a little bit of insight into what my risk tolerance is. But really, at the end of the day, experience trumps all. And the only way that you're going to find out how your emotions play out in stocks is by actually trading them. And so that's why I feel that doing the paper trading is the best way to assess your risk tolerance. And after you have done a little bit of paper trading for a while, fill out that investor questionnaire and see if you can actually get some value out of that. Alright guys, the third thing to consider is your investment platform of choice. This one is very important because it can actually save you a ton of money by doing only a little bit of research in the field. And what I mean by an investing platform is actually the brokerage that you're going to be using to perform all of the trades like a buy and sell of a stock. Now, what I do recommend is trying to find a low-cost option for your brokerage, and this is to avoid maintenance fees on your account balance, but also to avoid trading fees altogether. For example, if you were to go with an established bank like TD, you could actually apply for their self-directed investing account, but you'd be paying $10 every single transaction or trade that you do. So every single time that you buy or sell the stock, you're paying $10. In addition, the TD account actually has a maintenance fee of $25 if you don't maintain $15,000 in the account, and that would happen every 3 months. On the other hand, an example of a low-fee platform is called Robinhood, and that's only in the United States, but it actually has no trading fees whatsoever and no account minimum balance. If you live in Canada like myself, you can actually use Questrade, and they're actually one of the cheapest brokers that you can get by only paying about $4.99 per trade up to like 500 shares. In addition, there's actually no charge to buy ETFs, and if you're under the age of 25, there's no account balance fees. So obviously guys, we want to avoid high trading fees because over time these can definitely eat into your returns, but also your cost basis is going to increase on every single purchase or sell that you make. And it's completely possible to avoid these fees altogether or have them significantly reduced by using the accounts that I just mentioned. All right, so now that you've got your low fee investing platform, now you have to choose your investing type of account. This is by far one of the most difficult parts for new investors because there are so many different types of accounts and they all offer their advantages and disadvantages. So in this video, I'm gonna make it simple for you by only telling you the accounts that you should consider. First of all, when you're opening an account with an online brokerage, you're going to have the option to choose a general account, which would be a cash, margin, or options account. For all new investors, I would personally recommend only opening a cash account because this allows you to fund your investments with the money that you already have, and you can just transfer all of your money from your initial bank account into this brokerage account. The cash account actually allows you to make buy and sell purchases of any equities of your type. And honestly, just forget about margin and option accounts because these are for skilled investors only. So then after choosing a cash account, you're gonna have the option of choosing a registered account type. And if you're in the United States, I would highly recommend choosing a Roth IRA. This account allows you to invest all of your after-tax income and not have to pay any tax on the capital gains that you would normally have to pay tax for. If you're wondering about the equivalent account type in Canada, it's called the tax-free savings account or the TFSA. Now, just a warning here, it should be noted that you're only allowed to contribute up to a certain amount into these accounts, and it definitely varies per person and when you were born. This is just because the accounts are so amazing not having to pay any tax on the gains, so you definitely want to figure out what your limit is yourself. And so after you've been able to max out the limit on one of these tax-free accounts, whether it be in Canada or the United States, you can then move on to another type of account, which is your registered retirement account. So in the United States, this would be called your 401k, and then in Canada, it's actually called your Registered Retirement Savings Plan, or RRSP. And essentially, you're putting in pre-tax dollars so that they can grow pre-tax, and then eventually you pay tax at the end when you withdraw it in retirement. Overall, this sequence of opening your accounts is definitely the best and will give you the most benefit from your investments by compounding your money and paying no tax from the start. All right, guys, last but certainly not least, number 5, you have to set goals before you start investing. Goals, along with everything else in this video that I mentioned, will certainly set you up for success and definitely allow you to realize what you would like to buy in the stock market and what you're comfortable with. So what you should do is simply start by asking yourself, what do I want to achieve by investing? And honestly, guys, this is a really hard question to answer because everyone wants to make money, but obviously everyone's risk tolerance is different. So let me give you a few pointers. First of all, if you're happy with getting average or normal returns just by following the general stock market index, which is typically about 8 to 10% per year, you're gonna wanna buy ETFs or index funds. And these ETFs or index funds will just mirror the general market performance, so you won't get anything above or below. And it's also completely fine to just say, I wanna beat inflation, which is typically about 2 to 3% per year. In this case, you might wanna be buying bonds which offer lower risk and lower returns, but it's definitely something safer for you. Once you've determined what you want to achieve in the stock market, you can start setting goals like I want to put aside $5,000 this year for the stock market, or invest $100 per month just to go into your brokerage account and start building that portfolio money. These goals will help hold you accountable and make sure that you're investing more money each year so that you can build that portfolio base and have compound interest take over from there. And thank you guys so much for watching today. If you did enjoy or gain value from this video whatsoever, just smash that like button down below. I really appreciate it, and it definitely helps out my channel as I'm just a small YouTuber trying to grow up. And if you haven't already, you'll definitely want to subscribe for more content on personal finance, investing, and business for the future. Until next time.